G'day folks, and welcome to a very quick on-chain update that we're going to be calling Dip or Doom. And this series is kind of prompted because of, as we come in towards the halving, Bitcoin is retesting that 60K level. And what I want to do is just give a bit of a snapshot of kind of how I go about analyzing moments like this. Because obviously when you get big candles, whether they be up or down, it creates a level of uncertainty. So certainly just giving you a bit of a view into how I view these markets, how I kind of form my opinions when I'm looking at on-chain data, and just trying to assess what's happening. Is the market, is this a dip or is this something a little bit angrier, closer to doom? Now, just as a quick heads up, we'll start with one chart that we actually did in our first premium Substack newsletter, talking about top heaviness. So we'll talk about what that metric is currently doing. And then we'll zoom in and look at some other metrics, which are all about short-term holder and long-term holder profit and loss, which are really, really powerful tools. And we're going to look at some really cool Glassnode charts, which are actually brand new and go down to very, very high resolution to allow us to do this. So before we do get started, do give us a like, a share, and a subscribe. And if you haven't seen, we actually released a new post about the halving, trying to assess whether the halving is priced in only for our paid Substack members. So you will find that over there at newsletter.checkonchain.com. And without further ado, let's get stuck right into the analysis. So as I mentioned, we're going to be looking or starting this by looking at the short-term holder supply and loss. Now, this is a metric that we covered in a bit of detail, actually in our first paid Substack post, really looking at this concept of top heaviness. So I won't go into all of the details. You'll find all the juicy details over there in that post. So I'd strongly recommend checking that out. What I do just want to flag is down here on the right-hand side, this is the amount of short-term holder supply in loss versus the total short-term holder supply. And what you can see is that we've actually, where we wrote this report and said, hey, top heaviness is potentially a risk, we were up here at this mean level, we've actually started to increase. So on this price dip down towards 60K, as we get closer and closer to that short-term holder cost basis, we're seeing more and more of that supply. It's gone from about 2.2 million all the way up to 2.8 million short-term holder supply and loss. Here is our +1 standard deviation level, which is where it would go red. Now, when would this thing actually go red? Let me just put this onto cycle 4, just so we can really zoom in on our current price action. As you can see, we are in the process. We haven't quite got down there yet, but we're in the process of getting closer and closer to the short-term holder cost basis. And notice that when we get down below that short-term holder cost basis, it's really what creates that top heaviness. So these orange and red bubbles are actually based on how much supply is in profit or loss, not based on the short-term holder cost basis. But when we slice down below it, it's usually coincident with us getting into a bit of a top heavy market, right? So I'll leave it there because again, all of these details on how we define top heaviness, you'll find all of that in our Substack as well. And just before I do forget, these dip or doom posts, we'll be doing these ad hoc whenever there's kind of a meaningful move in the market, both to the upside and the downside. Hopefully it won't be called dip or doom if we're moving higher. But these will be available only for our paid Substack members. So this one here is kind of a bit of a prelude and kind of the stuff that we're doing over there at Check Onchain. But really just giving everyone a bit of a flavor. But future editions, they will be for our paid members only. Okay, so one tool that I like to look at, I mean, the question is, now that we're in some kind of a dip, we're testing that $60,000 level, what are some tools that I use to assess whether this is a dip or indeed is it doom? And really, a lot of this will be focused on the short-term holders, people who recently acquired their coins. And we're going to start with MVRV and SOPR because those two metrics are actually siblings. MVRV is the unrealized profit or loss held by this cohort. SOPR is the realized profit or loss, the amount of coins being locked in and actually taking those chips off the table. So as we're not quite at the short-term holder cost basis, but as we start to really get into its territory, what are some of the behaviors that we want to see? And the things that we want to see will look very, very similar for MVRV and SOPR. What we want to see is these beautiful textbook retests of the break-even level of 1. This is essentially a retest of the short-term holder cost basis. Little undercuts are good. We actually want to see this. We want to see people get tested, test the resolve, because what happens is that people panic at these moments. So we've seen it here in early 2021. We actually saw a beautiful retest in September before we punched up to new all-time highs. And 2023, we had several of these retests, and we're on our way back down, almost coming down to test it. Now, of course, we don't have to get below it. We also don't have to touch it. But it's all about the behavior pattern. Do we see people step in and actually defend that cost basis? What we don't want to see is the inverse. Note that in bear markets, this thing will act as resistance. This is people selling their cost bases. Give me my money back. I want that to take that whatever exit liquidity the market offers and selling at that cost basis. So at this point in time, if we assume that this is a resilient uptrend, we should expect the short-term holder cost basis to hold somewhere in that $58,000, $59,000 region. We would like to see even a bit of an undercut. That's good, but we want to see a swift recovery. SOPR operates via very much the same principles. We do not want to see this kind of behavior where we're getting these regular retests. This is people in a bear market. I'm in just a little bit of profit, get me out. I'm in any kind of profit, get me out, sell my cost basis. Then we go into a loss period. And then we get back up, a bit of hope. Nope, that's not it either. And it just keeps getting dashed and dashed until we finally bust through. And note the character shift in 2023. Suddenly we start finding support. And again, sometimes you get some deeper moves, right? These are scary maneuvers. Back here in August, this had the potential to this was actually quite top heavy as well. We could have actually gone into bear market phase 2 at this point, but the market held it and we got this nice swift recovery. So what we've got is a really, really strong, this is telling us that short-term holders who bought the local high, call these folks the lettuce hands, if you want to use that terminology, are essentially taking the L and exiting their position at a loss. This, in terms of how these on-chain metrics, what they're describing the crowd. So if we're a contrarian and we believe that this is a resilient uptrend, we should expect the short-term holder cost basis to hold. We should expect this to actually get recovered fairly quickly. But of course, we now have a set of rules. If that doesn't happen and we move into a different regime, then we have to change our bias, right? So this is the way that I usually think about this data, looking for, this is my rule set, this is my expectation. If that expectation fails, then I will flip my bias accordingly, because of course, none of us can tell the future. Now, what I want to close out on is just two charts, very, very quickly, same principles, same idea, but we're going to look at it from two different angles, long-term holders, short-term holders. The first question I want to answer is, for long-term holders, are they panic profit taking into the top, right? So where we are right now, some people, when the market corrects, they go, oh man, I really wish I took my profits at 73. Well, the next best time is kind of now, and they panic take profits. So what we've actually seen with long-term holders, they take a lot of profit into these peaks, cools down, the market rallies again, they take profits again, market rallies, and then they put, they're taking profits and actually helping establish these local peaks. And then as the market goes into consolidation and correction, notice that generally speaking, long-term holder profit has cooled down. It's chopping around, but it's kind of hit this baseline. It's not really ticking that much higher. So on first inspection, it would look like long-term holders probably aren't panic profit taking. Yeah, a little bit here and there, but nothing that's kind of standing out. It doesn't look like anything that we saw back over here. You could argue that this could actually be more along lines of panic profit taking. Market was selling off. Bunch of old coins came back to life thinking, whoop, it's over. And who knows, maybe it is over, but this is kind of what we're looking for and we're not seeing it just yet. So lastly, let's move to the short-term holders. So where we're looking for panic profit taking with long-term holders, we're looking for panic selling losses for short-term holders. Now, why? Because essentially most people are not very good at trading. And what ends up happening is most people will end up buying a lot of coin when it feels really good. And that's usually when numbers going up. And as you know, when number go up, number often go down. So number go up usually creates this confidence. People buy high, they hodl it all the way down, and note that we get all of these realized loss spikes almost perfectly aligned with dips, right? When the market dips, we get a huge spike in losses by short-term holders. Market dips, huge spike in losses. Market dips, each one of these, 1, 2, 3, every single dip that we've seen, we've got panic losses. These are people who are spending coins low. They bought high because they're realizing a loss, right? By definition, we're looking at realized loss. So they bought high and they sold low. They bought high and now they're selling low, 1, 2, 3. This is essentially what you do want to see. As a contrarian, you kind of want to see people doing the wrong thing at the wrong time. This is a great example of it. So anyway, hopefully that's a useful overview. This is the way that I usually think about these things. I help establish, how am I thinking about this uptrend? Is it still resilient? Do we still have that kind of upwards momentum? And then are we seeing people making the wrong decision at the wrong point in time? SOPR going down below 1, realized price getting tested and holding, people selling, increasing volumes, and kind of let us handing out at the lows. Now, of course, if the market decides it wants to go lower, it will. And we have to be prepared for all environments. These are just some ways that I'm thinking about and kind of setting my bias and setting my time frames and understanding how the market works. This is the kind of framework that I'll look at, right? I want to see what long-term holders are doing. They seem to be pretty benign, so I'm not too fussed about them at this point. And therefore, we look at the short-term holders. They kind of seem to be buying high and selling low. And in markets, that's quite often what you're looking for, particularly in uptrends. These are the behaviors which are very, very common. Anyway, hopefully that was a useful session. Let me know if you have any questions or comments in the section below. And as I mentioned, all of these dip or doom videos, they will be, and the posts themselves, they will only be for our paid Substack subscribers moving forward. So if you are watching this and you kind of enjoy this kind of content, we do try and, when the market's a bit choppy, get this kind of stuff out as quickly as we can. Because, obviously people, as I mentioned, uncertainty comes from volatility. And I think that some of this data and some of these tools can just help us understand the mechanics of what's really going on. Anyway, I'll catch you in the next one. See you then. Cheers.